You are watching Market Watch, the brief overview of the key events from the world of finance. Yesterday we observed a very interesting situation that shows the true picture of what is happening. Just on Tuesday, we talked about the fact that demand in the stock market is due to the expectation of a reduction in the key interest rate, and today we are discussing the inability of investors to continue growth. This is extremely important information, because the fall in shares of only one company could completely negate all optimism from the expectation of easing the monetary policy of the Federal Reserve. At first glance, this situation may seem mundane, because the collapse of the shares of the Disney Media Corporation is a significant event for the stock market. But in fact, it is impossible to compare the degree of importance of these two events. After all, even a significant drop in the value of Disney shares is incomparable in terms of the impact on the market of the prospect of a reduction in the Fed's key interest rate. Nevertheless, key stock indexes ended the second trading day of the week extremely close to the opening prices. This indicates the uncertainty of buyers and the high risk of the formation of another wave of sales. To do this, it is enough to have any information indicating the stability of the U.S. economy. Shifting to the commodity markets, we will also pay attention to the obvious uncertainty. US WTI crude traded sideways between $78 and $79, while gold was stuck above the technical support level of $2,320 per ounce. But in both cases, there is a risk of a bearish scenario. Oil may continue to decline, amid an increased likelihood of a cooling military conflict in the Middle East. Gold also loses out from the reduction of geopolitical risks, because in this case, the demand for protective assets will decrease. Another bearish factor for gold is the risk of lowering the key interest rate. Indeed, in this case, a so-called soft landing may occur, bypassing a deep recession. Concluding the review by the cryptocurrency market, it is immediately important to note the fact that Bitcoin and other coins are at high risk. First, key stock indexes are stuck, indicating a lack of clear demand for risky assets. Secondly, investors need an additional reason to buy cryptocurrencies at current levels. Since a new strong bullish fundamental factor is not expected to appear in the foreseeable future, there is a risk of deeper sell-offs. This risk will remain elevated until Bitcoin returns above 67,500. That's all I have. Follow the news carefully and be prepared for all the surprises of the market.